So what life insurance company should I choose if I want a whole life insurance policy that is set up for maximum cash value? What we're going to go through today is exactly how I would choose the company that I feel would be best for me if I wanted a whole life insurance policy set up for maximum cash value. And this is the same process we'll take individuals through that we're working with to help them pick the company that they feel is truly best for them, because we don't want to force any one company on anyone. So there are typically two items that help us make the right choice. First, we've got track record of actual performance, meaning does the company have proof of performance with whole life insurance policies, meaning they can show you and me, here's a policy that was issued 10 years ago, it was started 10 years ago, 20 years ago, 30 years ago, whatever. Here's how much was paid in, here's the cash value, and the internal rate of return, that's the growth rate, is at least 4% or even a little bit higher. Can the company provide that? Because this can be very difficult to get from companies. And a big problem with whole life insurance sales when one is interested in the cash value is that on an illustration, we'll see beautiful values projected. But then in reality, the actual results are much less. And this results in unhappy policyholders. I think I'm gonna have $1 million, I end up with $600,000. I'm like, dude, where's my money? Like, no one wants that. So this is why we got point number one, track record of strong actual performance. And the easy thing to do here is copy what the wealthy corporations and banks do when they select companies, which are your 4 major mutual companies. That is my preference. Now, there are people we work with that prefer smaller companies. We go through the pros and cons, and if someone wants a smaller company, we will help them with that. But we primarily recommend the 4 major mutual companies, which are MassMutual, Guardian, New York Life, and Northwestern Mutual. Our company, IBC Global, primarily uses MassMutual and Guardian because of their flexibility. But there's a lot of quality there, in my opinion. Next, we've got premium and PUA flexibility. So with that, I'm going to explain these terms a little bit first. The premium is a fixed amount, meaning when you start your policy, whatever your premium is, this is also referred to as your base premium, that's fixed for the life of the policy. And when I say life of the policy, that could be a policy where the premium is due until you're 100, or it could be a policy where you only pay into it for 5 years. Could even be less than that. So you don't have to pay that fixed premium for your whole life. I always like to mention that because we've got the word whole life insurance. People sometimes think we have to pay into it our whole life. In order to add PUAs, we do need to pay the base premium. There are some rare exceptions to that. If I've had a policy and the company allows PUAs to be paid after the premium is paid up, an example would be a Guardian 10-pay or 15-pay policy. The premium is due for 10 and 15 years, but they'll accept PUAs after that premium paying period. But that's one exception there. Some companies have rules like that. Generally speaking though, if you want to add PUAs, you need to be paying the premium each year. Now the premium usually does not build cash value in the first year and sometimes the first and second year. I would check out any of our videos that go through policy design as we provide a thorough breakdown on that. Then we've got our paid up additions rider. This is how we maximize cash value. In the first year, I'll see the majority of that show up in cash value right out of the gates. And this is what really accelerates the cash value growth, gives me a break-even point between years 3 and 5. This is the key to maximizing the cash value of a whole life insurance policy, minimizing the premium and maximizing the cash value. So here's an example of a traditional whole life insurance policy. We've got option A, you pay $10,000 per year. Since it's all set up, it's all going toward premium in this example, you're billed for $10,000 every year. You have 0 in cash value in the first year, and it takes 10 to 15 years to get your money back. That's your break-even point. Then we've got option B, which can be the exact same whole life insurance policy. You pay the same $10,000. The difference here is that you're only billed for $1,000 per year. The other $9,000 can be added into PUAs, and you can set it up where you pay $10,000 every year. You just have $1,000 go toward the premium, the other $9,000 toward PUAs, and this gives you $8,700 in the first year alone. The other $300 or some of it will go toward a term insurance rider, which is needed to provide a MEC, which is a taxable event on a whole life insurance policy. And in an example like this, which can be the same policy as option A, it only takes 3 to 5 years to get your money back instead of 10 to 15. So generally, we don't want this, and we do want this if our goal is to maximize cash value. Now, a little bit more information on flexibility. So let's say you want a policy where you want to fund, we'll keep it simple, $10,000 per year. And if you want to fund $100,000 per year, you would just add a 0 on top of this. But you don't want to get a bill for that amount. So you want to be able to fund up to $10,000 per year. But the idea of getting billed for that every year kind of stresses you out. And if that's $100K per year, it could be even more. So how this would be set up in an ideal world would be like this. I'd have a $1,000 premium. You know what, that might be $1,200 or $1,300 with the premium, or with the term insurance rider, that is. And then I would have the rest go toward that paid up additions rider. Add the two together, what do you have? $10,000 per year. Now the thing about a design like this, I'm committed to this piece. This paid up additions rider is flexible, or I can even set it up where it's optional, meaning I only add it if I want to add it. I'll go through an example of these two companies below in a minute. But what that does is provide a lot of flexibility, and when choosing the right insurance company, this is extremely valuable information because not all companies allow me to just add PUAs anytime I'd like. They all have different rules around this. We're going to go through an example of just two companies. But when we start to look at other carriers, they all have different rules. Let us know if you have any questions about the PUA flexibility, but it can be complex. When we look at the specific rules, there is my point. But if we want it to be flexible, or I want to be able to add 10K, but not be committed to that, that's where that flexibility is valuable. So, two examples here. We've got Mass Mutual. I can set up a policy just like what we looked at there. So I can have, I'm going to use round numbers here, a $1,000 minimum premium, and then add $9,000 per year, which gives me a total of $10,000 per year that I'm paying. And Mass Mutual is fantastic if I set this up and I said, hey, I think I can fund 10K per year, but what happens if I have a year where things are slower and I can only add 5,000, or maybe it's 2,000? Well, what you can do with Mass Mutual very easily, if the policy is set up appropriately or set up properly, is on your premium due date, you can adjust that PUA rider amount, the amount you're funding toward the PUA. So what that means is you might pay, let's say, you might fund years 1 through 5, 10K. Then the 6th year, something happens and you say, hey, I can only fund 3K this year. No problem. Remember, the premium piece is fixed. So what would happen in year 6, you would still have a $1,000 premium, but if we would scale the PUA payment down to $2,000, add the two together, you have a total of $3,000. Then if you want to increase it the next year or 5 years later, whenever, we would scale it back up. And again, the policy does have to be set up properly to be able to scale it back up without going through underwriting or anything like that. But the main thing here is, if I'm comfortable of having that flexibility one time per year on my premium due date, that's where Mass Mutual works very well. Someone says, I want to be able to fund it at 10K per year for 30 years or something like that, with a chance of having to make one time per year payment adjustments, you can do a lot of damage in a good way with the Mass Mutual policy. Guardian, on the other hand, let's assume you've got the same setup here, because you can do the same thing. You want a policy where you're committing to 1, adding in another 9,000 in PUAs for a total of 10. What you can do with Guardian is commit only to the $1,000. It might come out to $1,200 or $1,300 with the term insurance rider. So let's say we're going to round up here. $1,300 a year. It's the premium plus the term insurance. That's what you're billed for. If you have a question about the term insurance rider, leave it in the comments below and we can share a video with you that goes through the term insurance rider. But here we're assuming you're billed for that. So you pay that one time per year, and then 100% at your leisure, you can just log onto your online portal and throw money into PUAs. So you're not committed here. Some people don't like that because they like the forced savings aspect. But you'll see a lot of people who are using the policy for real estate, for business, and their cash flow fluctuates, really like this approach because they can commit to a small amount that never feels like a burden. One might express, I feel like I could hit that in my sleep, no problem. And then I'll add additional funds to PUAs at my discretion. Can have a lot of fun with that. So it's very common to see a design like that. Where it's really common is if someone is funding 100K per year, or they really want to have a high stretch amount that they know they can hit, but maybe not every year, what they'll do is set it up where literally we're just multiplying everything by 10. The minimum is 10,000. With a term rider, it won't be 13,000 actually, be closer to 11,000. I'm billed for that once per year, and then I just pour excess funds into the policy at my discretion. So now I can commit to a low amount, add more discretion. When I'm adding more funds, I see the majority show up in cash value, which I have access to now for opportunities. So the flexibility is huge there. So what insurance company should I choose? First thing I would look at is making sure that the company has a track record of actual performance. This is why I do like the major mutual companies, because we've been able to get that from them consistently, proof of performance. And then the second piece is flexibility. And different companies are going to have different rules. We've got a video that goes through 5 different companies and the PUA flexibility. Let us know if you'd like a link to that video, and we can definitely send that to you. Please leave that in the comments below or email us directly. These are 2 examples, but really learning the flexibility features with different carriers or insurance companies helps us refine that decision-making process. So I hope you enjoyed this video. Please let us know if you did. Please hit the like button, subscribe for more, and thank you so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.